This might be one of the best-run companies in all of software. It grows revenue almost 80% a year. It's profitable. And its software is becoming the operating system for artificial intelligence inside governments and giant corporations. It's also one of the most expensive stocks on the entire market. Meet Palantir, the stock Wall Street simply cannot agree on. One analyst says it's worth $70, another says $255. Same company, same day. So the question is brutally simple. Is Palantir a generational, once-in-a-decade compounder, or the most overpriced stock of the entire AI boom? The answer comes down to one number. Stick around, because part 3 is where most people get Palantir wrong. Palantir is a $290 billion company. We'll run this in 3 parts. Why the business is so beloved, why the price is so terrifying, and the chart. Then a verdict and the one metric that settles it. Let's start with why the believers are so devoted. And to be clear, the business is genuinely spectacular. 1. The growth. Revenue is growing around 79% year over year. For a company this size, that is almost unheard of. And it's not slowing down, it's speeding up. 2. The engine. Palantir's commercial business, selling its AI platform to regular companies, grew nearly 100% in a year. Its government business grew 66%. Both halves are on fire at the same time. 3. And this is what truly separates Palantir. It's not just growth, it's profitable growth. There's a famous benchmark in software called the Rule of 40, where growth plus profit margin should add up to 40% to be considered elite. Palantir's score is around 138%. That is not a typo. It is one of the best numbers the software industry has ever seen. The fastest growth, both engines firing, and elite profitability. So what on earth is the problem? The problem is the price. And it is a very, very big problem. Palantir trades at around 65 times its sales, not its profits, its sales. To put that in perspective, a typical software company trades in the single digits. Even most great software companies rarely go above 15 or 20. Palantir is at 65. On profits, it trades at over 130 times earnings. Here's what that actually means. At this price, the market is not paying for what Palantir earns today. It's paying for years, maybe a decade, of flawless, uninterrupted hyper-growth, all pulled forward into today's stock price. And here's the danger in that. A stock priced this perfectly has almost no room for error. The growth doesn't just have to be great. It has to stay spectacular quarter after quarter for years. The moment it merely slows from amazing to just very good, a 65 times sales stock can fall hard. In fact, it already has, dropping more than 20% from its high. So here's the scorecard. On one side, nearly 80% growth, a booming commercial engine, and the best profitability profile in software. On the other, 65 times sales, over 100 times earnings, and zero room for a single misstep. The best business or the worst price? For a tiebreaker, we go to the chart. Fundamentals tell you what. Technicals tell you when. And Palantir's chart shows a high flyer that has come back down to earth. After peaking near $207, the stock has fallen to around $121, down more than 20% over the past year. It's now trading in the lower half of its range, which runs from about 106 at the bottom to 207 at the top. Momentum is dead neutral. The relative strength index sits around 50. Not oversold, not overbought. The market, just like the analysts, is completely undecided. The levels that matter. Palantir recently broke below a key support level around $129, which now flips into resistance overhead. Below the current price, the line in the sand is the 52-week low, near $106. Lose that, and the correction gets serious. To turn bullish again, the stock first has to climb back above $129. So the chart says, A former high flyer, cooled off, sitting in the middle of its range, waiting for its next earnings report to pick a direction. So, generational compounder or priced for a fantasy. Here's the honest framework. The bull case is completely real. Palantir may genuinely be building the single most important software platform of the AI era, and businesses this good, growing this fast, are extraordinarily rare. If it keeps executing, even this price could one day look cheap. But the bear case is just as real, and it's about math, not doubt. At 65 times sales, you are not buying a great company. You are buying a great company at a price that already assumes a decade of greatness. Great business and dangerous stock can both be true at the same time, which brings us to the one metric that settles the entire debate: the revenue growth rate. Not the revenue, the rate. Watch it every single quarter. As long as Palantir keeps growing near 80%, and especially as long as its U.S. commercial business keeps accelerating, the bulls are right, and the stock grows into its valuation. But the very first quarter that growth rate slips, from spectacular to merely good, is the quarter this stock's biggest support. Its story cracks. At 65 times sales, deceleration is the only thing that truly matters. Pair continued blistering growth with a move back above that $129 level, and the believers have their proof. Until then, Palantir is the ultimate high-quality, high-danger stock, the best business in the AI boom, wrapped in one of its riskiest prices. A stock to understand completely before you ever touch it. That's the full breakdown, the growth, the valuation, the risk, and the why behind all of it. If this helped Palantir make sense, subscribe. Every week we break down one company on Wall Street exactly like this, so you can invest with a framework instead of a feeling. The free breakdown sheet with all the numbers is linked in the description. Quick but important. This channel is for education and analysis only. It is not financial advice, and I'm not your financial advisor. Do your own research or talk to a licensed professional before investing a single dollar. What company should we break down next? Drop the ticker in the comments. See you in the next one.